Hey kids, I know you missed me. This is your next video podcast called Hoover and the Stock Market Crash. So we had been talking about the 1920s and how things were usually pretty great in the 20s, except for farmers. We said how they struggled in the 1920s, but otherwise there was a pretty optimistic mood. Everything seemed fine. Workers were making more money, had more time off, going to sporting events, music, arts, everything, almost everything was going well. People were able to save some money, and they were able to put them in maybe even in the stock market. A small percentage, maybe like a fifth of people, a fifth of Americans or so, were putting money in the stock market. But still, that's a pretty big percentage. And for the most part, the 1920s was a bull market, as you can see by the arrows and by the graph here. That a bull market is when the stock prices are increasing. That's good. We want that. Okay, so the way you can remember that a bull market is like the bull's horns are pointing upward. Okay, pointing up. That's the best I can do for you. They actually have a statue of the bull outside of the stock exchange in New York. I guess as a sign of good times to come. The 1920 stock market was not a bear market. I guess a bear market is just the opposite. It's a bad market. And you can see here the stock prices are dropping. The value of stocks in general are going down. The clever way I guess you can remember that is maybe the teeth of a bear are pointing down, like the fangs. I don't really think they're called fangs for bears, but we can call it that, I guess. Are pointing downwards. So there you go. That's the best I can do for you. Things were good. It was a bull market. For example, 1925, the market value of all stocks was 27 billion. That's, I don't know, it's a lot of money, but we have to get a reference point. What does that mean for us? So, like in 1928, within 3 or 4 years, the stock values rose by almost $11.4 billion. That's incredible. That's a lot. For just a few years' time for the stock values to go up that much. And look what happens 1 year later. By October 1929, in just a total of 5 years, the stock values go from $27 billion to 87. So more than triple the value in 4 or 5 years. And that's a little iffy. There's something going on here, so let's talk about that. Well, Thursday, October 24th, 1929, this is known as Black Thursday. Not your shopping day, Black Friday, but this is called, I'll explain that in a second. This is Black Thursday, October 24th, 1929. This is a day that the stock market had a somewhat smaller crash. I mean, it was big, but not the big one that we're leading to here in a minute. But Black Thursday was a sign of things to come. What happened was people tried to stop things from spiraling out of control. So big bankers, 5 big bankers in the country meet and try to stop the downward slide, by buying up a bunch of stocks. For example, what does this mean? Like if no one wants to buy Crocs anymore, the rubber shoes called Crocs. If everyone thinks they're no longer cool and they're out of style, then the price of Crocs, I'm sorry, would go down a lot, and it would go on sale. No one would want to buy them. They go on clearance. Well, theoretically, someone could single-handedly buy up all the Crocs around and say, oh no, look, there's nothing wrong with the price of Crocs. Nope, they're still popular, and then they could artificially keep the price of the Crocs high. Well, that's what these bankers try to do with the stock. They bought them all up, these shares that no one else wanted, and said, hey, everything's fine, no big deal. So the next day, stocks rallied, stocks values hold steady on rumors that these guys, these big wigs, were meeting. Okay, fine. The weekend happens, and then the stock market's closed during the weekend, and then Monday, October 28th, 1929, the market opens, and investors and the brokers are the middlemen between like you, the investor, and the stock market itself. You have to go through them. But everyone's kind of like, oh, should we sell? Should we not sell? What's going on? Everyone is very nervous. And with the stock market, being nervous is a bad thing. Today, with the stock problems, the economy, the president and important people on TV are always trying to calm our nerves, saying, no, things are going to be fine. Don't sell your stock. Everything will level off, and don't you worry. But it wasn't enough. And the next day, this is the big one. please, this is going to be one of these, just a handful of days that I want you to remember when you leave this class and go on with your lives. I want you to remember Black Tuesday, Tuesday, October 29th, 1929. This is the big one. So big stars, please, whatever you got to do on your notes. This is called Black Tuesday, the most devastating day in the history of markets. The big one, and I'll explain why that happens in a second. Just so you know, I'm sure some of you are thinking, why do they call it Black Tuesday? Why do they call it Black Friday? I think Black Tuesday and Black Thursday that I talked about a minute ago, those mean the same thing. Black as in like the literary term, black versus white, meaning like good versus bad in like old time writing, I guess. So black has a negative connotation. Like the clouds are looming, oh no, storm's coming, that kind of Black Tuesday. However, Black Friday that you're thinking of, the day after, what is it, Thanksgiving, I guess, for all the shopping, the reason they call that Black Friday, I'm sorry, is because normally when you keep records, accountants, if like breaking even is a line in the middle there, if you're below the line, then you're in the red, it's called, meaning your company's not making money. You're in the red. Red is bad. If you are above this line, the accountant would say that, oh, we're in the black. So they say that day of shopping actually puts companies in the black, meaning they actually start to make a profit for the year. So it's a good thing in that case, Black Friday, I'm sorry. But on this day, Black Tuesday, the bad day, prices fell so much in one single day that all the gains from that previous year were lost. Billions of dollars just gone. Okay, public confidence is shattered, and the investors are just like, whoa, what are we going to do? And there's stories of investors going home in New York City. There's stories of people, like young investors, jumping off of bridges, committing suicide, jumping off of buildings, because they're so desperate. They think, and they're pretty sure that this is it for them, that they have no hope, that there's no way they can recover. This was a huge deal if you had anything to do with the stock market, and as we'll see, not just as people with the stock market were affected. $150 million in margin calls were made. Okay, I think we've mentioned this margin calls before. I'll explain it in a minute also. But people wanted their money back, the margin calls. $30 billion in stock disappears in one day. $30 billion. Even today, that's a lot of money. $30 billion is a huge deal today. But back then, for that to disappear, let me explain something. What do we mean when we say money in the stock market disappeared? How is that possible? I hope you're asking that question because, I don't know, it doesn't seem to make sense. Here's an example. What determines the price of a house? Right? It's like how much the person who owns the house is trying to sell it. How much are they willing to sell it for? And then how much is the person who's going to buy it? How much are they willing to pay for the house? That's what determines the price of the house, right? You have to meet in the middle somewhere. But here, this is confusing. How can the same house, like take a Shaler, somewhat small three bedroom house in Shaler, be worth $150,000, which is pretty normal for this area, be worth $500,000 in San Francisco? I have a cousin that lives in San Francisco, and she says that, the regular houses that we have here, she just moved out to San Francisco. She said that those houses are worth $500,000, and they don't even have a basement, so they're actually smaller. It's just because property values. It's how much people are willing to pay for something. Like the house isn't actually worth $500,000. It's not like you can just you can't get that money unless someone's willing to give it to you. So like the stock, this piece of paper that says one stock in Apple Corporation, the stock isn't actually worth $55 a share unless or until someone's actually going to give you that money. Here's $55. I'm willing to pay you that $55 for you. Okay, great. So if you can't find someone to pay it, then it's not worth that much. Maybe they're only willing to pay $40. Okay, then it's worth $40. So the money, when we say they lost $20 billion in a day, the prices shouldn't have been that high. They were only that high because people used to be willing to pay it, but now the public confidence was shattered and people were no longer willing to pay that much. And so the prices just, boom, with the snap of your fingers, they're gone. It's a little confusing, I'm sorry. We'll try to explain it in class more if you need to. So reasons for the crash. We have three reasons. One, speculation. Speculation is buying stocks that you think may rise in price and then quickly selling them for a profit. Speculation. Speculate. You speculate. You think that, I think this stock in this company, Apple, is going to be doing well in the future. I'm going to buy some Apple stock. You speculate that it's going to do better, and you know that maybe next week it's gone up by $5 a share. Okay, great. I'll cash in, I'll pay, and I'll get a profit, and I'll go out and buy something with that extra money. Speculation. That's fine to speculate. However, if things don't stay, prices don't stay high forever, then you're going to lose out at some point. Buying on margin. People were doing this nonstop during the 1920s because the stock market was keep going up, 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 and people thought, oh, this is great. This is never going to end. I got to make some profit before it's too late. So people were gambling. That's what the stock market really is. It's gambling. They were gambling with borrowed money. So let's say that you're the investor. You decide you're going to invest a little bit of money in the stock market. You pay just a small amount, like maybe 5% of the total, to this middleman called the stockbroker, and then you just borrow the rest from him. He covers the rest. So say that you, for $1,000, you pay $50, and the other $950 comes from him, and you use that money, that chunk of money, and you throw it in the stock market, and you buy up a bunch of stocks. Well, what happens is, if something goes wrong, then he still really owns those stocks for you. You have to pay him back over time. But if something goes wrong, he holds those stocks as collateral, this stockbroker. So if you end up not being able to pay him back, he'll just sell your stock and get the money and make his money back and move on. Okay, that's fine. But people were doing this, and then the stock market crash of 1929 happens, Black Tuesday, and all of a sudden people had no money. And this is what we're saying, calling in the margins. Picture this guy right here being the stockbroker who gave you this money. Whoa, the stock market started to take a tumble. These guys said, hey, you investors, I want my money back now. I changed my mind. I want that money now, up front, please. Well, you and I we didn't have the money. We had borrowed it. We were taking a gamble, so we couldn't pay it. So guess what? Once the calls are made to pay it back, people didn't have money. So what do you think they're going to do? What are those brokers going to do with their money? They're going to have to sell that stock that they had been holding on to for you. But every stockbroker in New York Stock Exchange is doing the same exact thing. So what happens at your favorite store at the mall whenever there's way more, whatever cool shirt it is, then people are willing to buy. If there's an excess of cool shirts or excess of cool tennis shoes that no one wants to buy, the price drops a lot. It goes on clearance, right? Well, everyone's selling stocks, selling. No one's buying. Everyone wants to get the heck out of the stock market, for this week. So the stocks have no value. Everyone's panicking. Everyone keeps selling. It gets worse and worse. This snowball effect, right? And this is a fun fact. For your information, banks back then were allowed to invest your money that you put in savings into the stock market. So say that you had nothing to do with the stock market. You have a summer job, you babysit, or you shovel driveways, which wouldn't be a summer job, but whatever you do, you cut grass. You put your money, your hard-earned money, in the savings account at the bank. Well, those banks were able to take that money and turn around and put it in the stock market, which means when these stock markets crashed, your money was gone. Okay, today the government insures bank deposits, so your money's going to be there. But back then, that wasn't the case. In the left and right, banks were actually closing. There was nothing that said a bank couldn't close its doors and shut down. You lose. Your money is gone if this happens to you. So therefore, the crash not only affected people who were gambling in the stock market, right, which I don't feel all that bad for because they were gambling and they knew it, but it also affected people who were just putting their hard-earned money into regular savings accounts, which are supposed to be safe. So at first, economists predicted this quick recovery, that, oh no, calm down everyone, trying to calm everyone's nerves. Things will improve. However, the Depression rages throughout really all of the 1930s. And I'll give you a preview that the only thing that's going to truly bring us out of the Depression is going to be the start of World War II and all the production that's going to need to go on for that. And put this definition down, please, on your notes for what depression is, the economic term. We're not talking about something you have problems, you need to talk to a counselor. No. Get on some medication. No, that's not the kind of depression we're talking about. We're talking about the economic term, depression, which is a period of severely reduced economic activity characterized by rise in unemployment. Oh, hey, thanks, Dr. Phil. He's gonna help us learn tomorrow about the actual causes of the Great Depression. I know you're probably thinking, wait, I thought this was the cause. The stock market crash was the cause. I understand why you think that, but I'll try to help explain to you that the stock market crash was really just a sign of the fact that things were going on in the economy that were bad. It was a sign that things needed fixed, and there's problems that need to be looked at. So I'll try my best to explain it in class tomorrow, the causes of the Great Depression. Don't forget, right now, you're supposed to take a quick 5-question quiz on Blackboard to prove to me that you watched this video podcast. All right, we'll see you tomorrow.